Hello, everybody, and welcome back. Today, my guest is Rob Drijkoningen, co-head Emerging Markets Debt at Neuberger Berman. Welcome, Rob.
Welcome. Thank you for providing me the opportunity today.
Rob, today we want to discuss recent developments in China bond markets. So investors are turning their eyes to China. What is currently the case for China onshore bonds?
Essentially, it has three components to it. One is related to the sheer size of the market. It's a massive opportunity out there with lots of ways to add value into a fixed income or global portfolio. It's the second largest market in fixed income after the US. So few people realize how big it really is. And of course, that's related to the fact that until recently, there was no way of accessing that market. It also has much higher yields than elsewhere in the developed world. Currently, 10-year yields are around 3.2%, and that compares with the US about 2 percentage points higher. So you really have an attractive yield with a stable and strengthening currency. So that's a very conducive combination of the two elements of yield and performance going forward. It also has a credit rating which is the same as Japan at single A+. So it is within the emerging market space a higher quality. The second part of the answer is really in the fact that it provides a huge diversification. The element is essentially that if you look at both the government bonds in the onshore market as well as the onshore corporates, it actually has a negative correlation with US high yield and also to emerging corporate debt, for example. And it's close to zero for the hard currency space. So also in a global government bonds universe or US equities, it's extremely lowly correlated. So it has genuine diversification advantages. And in today's world, which is typically highly correlated, that's a very important element to dampen the volatility of an overall portfolio by including China. Also, the risk-adjusted return historically, the returns have been sort of in the mid to high single digit over the different segments, but the volatility has been very low at 2.5% to 3% typically. So that makes the risk-adjusted returns quite attractive as well. And we've got good reasons to believe that it might well be applicable going forward too. So you've got the yield advantage, you have the size, the opportunity set, and the diversification, and the limited volatility. So that is all that is to be had by going to China.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. How has market access for international investors changed in recent years?
Yeah, that's actually, it used to be that you need to get permission and approvals to get access to the onshore market via most notably the RQFI system, which was a quota system initially, and then the quota system was exchanged for just an approval process, which was semi-automatic. But that's been replaced since a couple of years, or replaced, it's still in existence, but there's been a new way of getting access to the market, which is the Hong Kong Bonds Connect access point. And that allows you to set up your paperwork in terms of custody and so on in Hong Kong, which is more aligned to international practices and allows you to have a communication with your custodians in English, so that there is a bridge from Hong Kong into the onshore market, so that you have access to the onshore instruments by having an quote-unquote offshore account. And that has made it possible for international investors to really find very easy access without having to speak Mandarin on your custody processes, operational processes, and so on, apart from the fact that it's pretty seamless. The only drawback at the moment is that you don't get access to exchanges yet, where the credit bonds are traded, but that's going to change in the future as well. So for now, it gives you access to policy bank bonds and government bonds, and that's where the bulk of the international exposure is indeed being made.
Can you elaborate a bit about the market structure? Who are currently the most important issuers and investors in the China onshore bond market?
Yeah, we carved that up in two areas. One is sort of the risk-free space. We think that China government is essentially risk-free. And if you look at that risk-free area, there's also the policy bank bonds, which are the three major banks in China by which the government implements their policies, like the Belts and Roads, but also other big infrastructure projects that need funding. And they are 100% owned by the central government and are deemed to be risk-free. So we consider them quasi-sovereigns. The government bonds and the policy banks combined are, well, they are each around 30% of the so-called rates market, which is the risk-free market area. And the local governments are 38%. So that's the largest component, but that's largely illiquid. So we can ignore it for our purposes. They typically get issued at a small spread over central governments and then are locked up in the bank portfolios. So, and that rates market is around $8 trillion. And then we have another $6 trillion, which we consider to be credit risk. And that is the larger part, the dominant part is corporate bonds, 60%, but there's also a very active money market part to that, that's 30%. And then you have some asset-backed and convertibles as a smaller segment of that market. So that's combined almost 8 trillion plus 6 makes it 14 trillion that is being captured in this rates versus credit space.
What are the current yield spreads of onshore bonds over hard currency bonds, and what changes did you observe in the near past?
Yeah, that's interesting because you would have to analyze, you can look at the yield differentials, but the way we look at it is typically from a spread difference point of view. So we look at local, say, corporate bonds compared to the local central government bonds and look at that spread, and then do the same thing for the dollar bonds. So the Chinese names that are issuing in dollars are then compared to the US Treasury curve. So that spread difference at the moment is still in favor of the dollar bonds, because after the pandemic, the spread widening was far more severe in the dollar space than in the onshore space. So in relative terms, we see a bit more value in dollars, and we can, of course, flexibly go from one into the other, hedging out the currency risk. But on average, the spreads in the dollar market are a bit more juicy. But on the other hand, they also should be higher because you get a bit of, let's say, disadvantage in terms of the credit quality. The assets of the issuers are typically onshore, whereas the offshore structures don't necessarily allow you access in case of default to the onshore assets. So that's a risk premium that needs to be embedded in the dollar space. But even allowing for that, currently the spreads are still a bit wider in the dollar space on average for the same issuers that you see in the onshore space, for example. And that's been due to the fact that the onshore market has behaved quite well during and after the pandemic, whereas in the dollar space, the upheaval was pretty serious, where things are now normalizing as well. So it's for us a relative value space where you can go from one to the other, but on average, the premiums are still a little bit higher in the dollar space at the moment.
So investing in onshore bonds always means having an eye on currency developments. So what are the current influences and how will China's currency develop?
Yeah, I mean, obviously you can hedge out the currency risk. So you can play a pure fixed income portfolio in China without having the currency risk. So obviously also in our strategies and products, we can easily hedge it back to the euro or to the dollar. That's not really an issue. Of course, you have to give in some yield because the short-term yields in China are roughly 2.2%. That means if you hedge it back to euro, you have to give up yields in order to hedge it out. To the dollar, of course, a little bit less. But we do feel that the renminbi risk is worth considering, given the strong growth patterns that we've seen in the past and likely to see in the future. Also, they came out of the pandemic far better shape than many, if not all, of the other developed markets. And the current accounts are close to balance, and they continue to attract portfolio inflows. So the whole balance of payment story is pretty supportive for the renminbi as well. So, but it depends, of course, on you need to be careful in getting currency risk compared to the risk on the fixed income side, because the currency risk can easily overwhelm the bond market risk. So you could at least hedge partially. That would be our recommendation.
So where do you currently find investment opportunities in the China onshore bond market?
Yeah, interesting. At the moment, liquidity is being tightened in China, and that has many different angles. The shadow credit angle is being squeezed out, and that shows up in the figures already. Interest rates are being increased, and deleveraging in the real estate sector is implemented, even though this will be a number of years. So we are currently erring on the side of caution, given that liquidity squeeze and also the effect that the reduced state sponsorship has on certain names that bottom up are more risky. So at the moment, we are a bit more defensively positioned in terms of the names and the sectors that we would invest in. For example, LGFVs, the local government bond finance, local government finance vehicles. They are more at risk in the current environment, where the bailout of the government is far from guaranteed. But we do think that in the course of the next few months, that will have run its course, and then liquidity will become a bit easier, and things are normalizing, and spreads have been widening already. So it's time to consider to start adding over the next few months to a more broader risk profile. And real estate always gives opportunities, but also domestic sectors which are more vibrant and related to consumer spending, that we see limited areas of attraction in the international space. But the domestic economy, being as vibrant as it is, creates many opportunities in many different areas. So there is not a generalized answer, but the opportunities are plenty. Sorry, yeah. One thing I would is the convertible bond market, which is also an extremely attractive, even if it's a small market, because of the convertible bonds, the strike price gets adjusted downwards if the equity is going down, to make it very attractive to convert at one stage. So that gives you a lot of upside with very limited downside. And that's something that we can add and are adding into our portfolios as well, especially if our equity view is supportive.
This was Rob Drijkoningen, co-head of Emerging Markets Debt at Neuberger Berman. Thank you very much, Rob, for being with us today and sharing your insights.
Thanks, Thomas, and thanks all for listening.